All right, today we're doing a deep forensic dive into a really nasty flaw in the tax system right in the nation's capital. We're talking about a legal trap, one that can actually force commuters between D.C. and Virginia to pay full income tax to both places on the exact same income. Yeah, you heard that right. So let's break down how this is even possible.
Okay, so here's our roadmap. First, we'll define this commuter tax trap. Then we'll look at the clashing rules in the two jurisdictions. We'll see exactly when the whole system breaks down, pinpoint the one form that acts like a tripwire, and then we get into the painful financial consequences and how to navigate this minefield.
All right, Section 1, the commuter tax trap. Let's treat this like a crime scene. So picture this. You follow all the rules, you do everything by the book, but you still end up legally required to pay full income tax to two different governments on the very same dollar. And this isn't some weird theoretical edge case. No, this is a very real trap for a whole group of commuters between D.C. and Virginia.
So let's just put the question out there, point blank. Could you legally be required to pay full income tax to both D.C. and Virginia on the very same income? The answer, and this is what's so wild, is yes, absolutely. And let me be clear, this isn't because you made a mistake or got hit with a penalty. It's a trap that's literally baked into the tax code itself.
We're calling this whole mess the Reciprocal Fail. See, there's this thing called a Tax Reciprocity Agreement. It's basically a handshake deal between states that's supposed to stop exactly this from happening. But for some commuters, that safety net just evaporates. It's gone. And it's not just a small crack in the system. It's a catastrophic breakdown right where these two different tax systems meet. So that brings us to the core conflict. How does this happen? Well, the whole problem starts because Virginia and D.C. have a fundamental disagreement. They have completely different and totally conflicting rules for deciding who is a resident when it's time to pay taxes.
And it all boils down to this. On one side, you've got Virginia. They use a concept called Domiciliary Resident, which you can find in their code, Section 58.1-302. This is all subjective. It's about your intent. Where do you intend for your permanent home to be? Then you've got D.C. They use something totally different, Statutory Resident. This is black and white, defined in their code. D.C. doesn't care about your intent. They only care about your physical presence. 183 days. That's it. That's the number that springs the entire trap. According to D.C. law, if you maintain a place to live in the district for 183 days or more during the year, boom, you are a D.C. resident, full stop. It doesn't matter what you intend. It doesn't matter if you have a Virginia driver's license, vote in Virginia, or consider Virginia your forever home. None of that matters to D.C.
Now, let's look a little closer at Virginia's definition of domicile, because it's known for being incredibly sticky. Your domicile is your true, fixed, and permanent home. And to change it, it's not enough to just move. You have to prove that you've left and that you have zero intention of ever coming back. The burden of proof is completely on you, the taxpayer. So you can see how keeping a house or even just a driver's license in Virginia makes it almost impossible to argue you've abandoned it.
And what about D.C.'s side of the equation, this place of abode? Well, that's just a fancy way of saying a place you could live in year-round. It doesn't have to be yours. A rented apartment or corporate housing totally counts. But here's the real kicker, the detail that catches so many people. D.C. counts your temporary absences. So let's say you have an apartment in D.C. for the year. That 2-week vacation you took still counts towards your 183 days. Those business trips, they count too.
Okay, so this brings us to Section 3, when reciprocity fails. You see, there's a system in place that's supposed to prevent all this, called the Reciprocity Agreement. It's meant to be a shield for commuters, ensuring they only pay tax to their home state. But as we're about to find out, that shield can shatter pretty easily. The way it's supposed to work is pretty simple. If you're a Virginia resident who works in D.C., you just file a Form D-40B with your job. That form basically says, hey, I live in Virginia, so please withhold Virginia taxes, not D.C. taxes. It's just a simple administrative tool to make life easier for commuters. But the key thing to remember is that it's designed for non-residents, and that one little word is where everything goes wrong.
So check out how this failure sequence unfolds. Step 1, you're a Virginia domiciliary. Step 2, you keep a place of abode in D.C. Step 3, you cross that 183-day line. The second that happens, you are now legally considered a resident of both jurisdictions. You're a dual resident. And since that reciprocity agreement only protects non-residents, poof, it's gone. The shield is down, and you are completely exposed to the full tax laws of both D.C. and Virginia.
So, you might be wondering, how does D.C. even find out about this? Well, here's the really ironic part. Most of the time, the taxpayer volunteers the information themselves, completely by accident. And that brings us to the evidence, the Tripwire, Form D-40B. It's a form you file to get a refund, but it can actually trigger a full-blown painful audit. I love this quote from the analysis because it puts it so perfectly. The filing of Form D-40B acts as a self-initiated audit. Think about that. You think you're just asking for a small refund you're owed, but what you're actually doing is inviting the D.C. Office of Tax and Revenue to put your entire year's finances under a microscope. So let's perform a little autopsy on this form, shall we? Its official purpose is for a non-resident to claim a refund if D.C. taxes were withheld by mistake, but look closer. First, if your W-2 has a D.C. address, that's an instant red flag. But the real smoking gun is a specific question on the form. It asks you point-blank to list the dates you maintained a place of abode in D.C. If you answer that question honestly, and the timeline you give is more than 183 days, you've just handed them a signed confession. And once you've handed them that confession, the audit sequence kicks off like clockwork. First, their system flags your D-40B. Next, you get something called an Information Document Request, or IDR, in the mail. This is a formal demand for your day-by-day logs, your lease agreements, everything. And if that log shows you spent more than 183 days in D.C., they don't just deny your little refund. No, they drop the hammer. They issue a notice of proposed assessment, reclassify you as a D.C. resident, and demand tax on your entire worldwide income.
All right, this is where it gets really painful. This is the double blow. You might be thinking, okay, this is a mess, but surely one jurisdiction will give me a credit for the taxes I pay to the other, right? That's how it's supposed to work. But that's where the second part of this trap springs shut. Virginia often refuses to give that credit, and that's what leads to true, unavoidable double taxation.
The entire issue hinges on a specific part of Virginia's tax law, Code Section 58.1-332. This law says that Virginia will only give you a credit for taxes you paid to another state on income that comes from sources outside of Virginia. And that little phrase, derived from sources outside the Commonwealth, is where the whole thing just completely falls apart for dual residents.
So what does Virginia consider a source? Well, for your investment income, we're talking dividends, interest, capital gains. They use a really old legal doctrine with a fancy Latin name, Mobilia Sequuntur Personam. All it means is movables follow the person. In plain English, it means that wherever your legal home, your domicile is, that's where the law considers the source of your investments to be.
And this matrix just lays out the brutal final math. Look, D.C. taxes everything because you're a statutory resident there. Virginia taxes everything because you're a domiciliary there. Now, for your wages, you'll probably get a credit from Virginia. So, okay, single tax. But for your dividends, your interest, your capital gains, Virginia says no. No credit for you. Why? Because of that Latin phrase. Virginia considers that income to be sourced in Virginia, because that's your domicile. So it fails the outside the Commonwealth test, and bam! You are taxed twice, once by D.C. and again by Virginia, on the very same dollar of investment income.
So after all that, we come to our final section, navigating the tax minefield. We've dissected the trap, so what's the verdict? How do you actually avoid stepping on one of these mines? The solutions aren't easy, and they require you to be extremely diligent.
Here are the key strategies, and you have to take them seriously. First and foremost, the 183-day ceiling. That is your firewall. The only surefire way to stay safe is to keep a detailed log and make absolutely certain you do not spend more than 183 days in D.C. Second, just avoid the D-40B trigger. Chasing a small refund is almost never worth the risk of a life-altering audit. Third, and this is a big one, if you can't avoid the 183-day rule, you might have to seriously consider formally and completely abandoning your Virginia domicile. And finally, if you do get audited, you have to fight like crazy for every single credit you can, even though it's an uphill battle for investment income.
You know, this whole situation really makes you step back and ask a much bigger question. In an age of remote work, where people are more mobile than ever, what does residency for tax purposes even mean anymore? The D.C.-Virginia trap is a perfect and painful example of what happens when old, conflicting definitions of residency crash into our modern reality. It shows that these outdated rules can create some truly unfair and very expensive consequences.